Hello and welcome, everyone. Thank you so much for taking time out of your day to join me for today's webinar. We are actually live here from Toronto, Ontario today. For those of you who have not met me yet in our live masterclasses, my name is Denice Lin, and I'm actually super excited to spend the next 30 minutes or maybe an hour or so to talk to you about an amazing topic about the new investor survival checklist. Now, today, we do actually have a special guest that's going to be joining us. So please help me give a big, virtually silent welcome to Nick Peitsch. Hi there, Nick.
Hi,
How
guys.
are you?
Oh, great. Thanks for having me on, Denice. It's a pleasure.
Would you like to give a little bit of an intro, a little sneak peek to what Nick is all about?
Yeah, for sure. So my full name is Nick Peitsch. I'm from Kelowna, British Columbia in Canada here, of course. I took my degree in engineering and graduated in 2019 from the University of Alberta. And it was actually in my third year of university that I really became interested in investing. So I was taking this finance course for engineers, and it was teaching me all about the time value of money and how important that is to get your money compounding from a young age. And I just realized I became super passionate about investing and wanted to learn a lot more about it. And basically, ever since I graduated, I've been teaching people on YouTube about my investing journey and just the entertaining content about dividend investing, stock market investing, a little bit of real estate investing in there too, and just everything around that subject, finance. So I'm super excited to be doing it, and I think it's a great opportunity of my time. And yeah, so that's basically me.
So sounds like you have a lot of experience, and that's why we're excited that you're here to really speak to us about this whole survival guide, right? So lots of questions coming in my head right now. For yourself, can you let us know what's the most important thing, or like why is it important for us to really know our investor profile when we're starting off investing?
Yeah, so the investor profile is super important, and it can help you avoid a lot of pain when you're getting into investing. So it helps you determine your goals, your investing time horizon, and your risk tolerance. In my opinion, those are the three biggest things that you can figure out from your investor profile. And one way that I figured out my personal investor profile was by taking the TD Investor Profile Questionnaire. And this was recommended to me by my friend, actually, back when I was getting started investing, and it just ran me through a bunch of questions to figure out, like, what is my time horizon? How long am I going to be investing? And, you know, what are my goals? What type of amount of risk would I like to deal with in the market, and all of these types of things. And so at the end of it, I became more aware of who I am as an investor and what I would like to do in the market. So it helps you figure out, like, are you going to be wanting to invest in individual stocks, ETFs, money market funds? Like, what is most important to you? So I think that's why it's really important.
You're young, you're a millennial investor. So for yourself, what goals are you investing for your future?
Yeah, so my investing goals, as I'm pretty young, my end goal is probably to have a huge nest egg to be able to live off of passive income through dividend income. And right now, at my point in my life, I'm taking a more moderate to aggressive approach to investing because I'm so young. I have the opportunity to make a few mistakes. And like, if the prices go down in my assets, it really doesn't matter at this age in my life. I'm going to have so many years to build up from there. So right now I'm just focusing on growing that nest egg and then eventually investing a lot into dividend paying stocks and receive that passive income through dividend income. I should mention that when I was starting investing, I took a more conservative approach and would only invest in blue chip stocks just as I was getting into investing and understanding the volatility of the market. But then as I continued my investing career, I ended up becoming a lot more confident with volatility in the market, and then over time transitioned to a more aggressive approach.
All right. Well, now we have your risk tolerance kind of stated out here, right? There's so many different stages. Now, aside from having risk tolerance, there's investments, securities, but there's also accounts. There's so many to choose from. Is there any factors that might have impacted the way you chose your account or how to?
Yeah, absolutely. So there's two main factors that I considered personally. So My age is definitely one of them, and then the amount of income and the tax bracket that you're in. So personally, I was recommended by my friend that also recommended the TD Investor Questionnaire, that the TFSA was probably that was his approach, and I actually took his advice, and I definitely think that for myself personally, the TFSA really worked very well. And when being such a young investor, it's important to get started in a tax-free account. And, being able to build those savings tax-free over time is excellent. Personally, I am not choosing the RRSP just because I'm not able to have a high enough income right now to be able to reduce my tax bracket over time. I think that once I'm in a higher tax bracket, I'll be able to take more advantage of the RRSP. But at this point in my life, I've just been focusing on the TFSA and then my cash and margin accounts.
So we talked about risk, and now we have an idea of how we might want to approach when choosing what account is going to be best for ourselves, because every individual is a little bit different, right? Now, the important thing is strategy. How to strategize and allocate funds into each account. Is there any tips you can provide us or any ideas?
Yeah, so personally, what I do is at the end of each month, I have an idea of what I've made and then what I've spent. And so I actually use the Mint app to calculate this. I will calculate the amount of money that I've made and then the amount of cash expenses. And then I will calculate my cash flow at the end of the month. And this is the amount that I'm going to put into my accounts. So this cash flow ends up being invested. And personally, what I did is I maxed out my TFSA from the beginning. And now that my TFSA is maxed out, I just invest the rest of my money into my cash account. And so this grows not tax-free, but it is still another option for me to continue building my wealth over time.
But after the funds are being transferred into the account, I guess, are we investing it right away, or do you have like a strategy in that area as well?
Right. So I'll deposit it into the account right away, but that doesn't mean that I'll invest it right away. I'm always looking for opportunities in the market. And so if there isn't an opportunity presenting itself right away, then I might not invest it right away. However, if there is a stock that I've been seeing, if it's been dropping and I just see it as very attractive fundamentals, then I'm definitely going to invest about 25% to 50% of that amount just to build up a position into that stock or dollar cost average down onto that stock. And this also could involve an ETF if I really don't see any individual stocks as an opportunity in the market at that point.
All right. So I was just bringing that up because as I started investing, I had no idea how the accounts work. So I assumed that putting in money into my investment account was investing. So it's great to clarify that that's not it. And there's still other things that's needed after that initial deposit to continue growing your account. But that's just a mistake on my end. Okay. So that's good to hear. So we have our investments, we have the accounts, and now we have an idea of how to use those strategies like dollar cost averaging, like you mentioned. Nowadays, a lot of people do like profit, right? So in terms of that, I see a lot of individuals looking to time the market or beat the market. What are your thoughts on that?
Yeah, so it's really proven that over time, that time in the market beats timing the market. Through research over time, it's definitely been proven that holding your investments over time is definitely a better approach than trying to time the market, because I believe it's through a period of 2001 to 2020, just missing the top 10 trading days, meaning the best times to be in the market, would actually reduce your overall returns by over 50% over that entire 20-year period. And so just staying invested is much like a much better approach in my personal opinion. And, even the professional fund managers and economists can't even reliably predict where the market's going to be on a day-to-day basis. So, us as individual investors really have no chance in trying to predict the timing of the market.
And you know what? I think it really ties into what you said earlier about your age, because that's also a big factor, right? So starting to invest early, since you're quite young as well. Why was that important to you? Or how did you start investing this early?
How did I start investing this early? So I definitely, like as I was in university, I took this course and it was very important for me to get started early. And basically the whole motivation behind it is understanding the compounding effect. And so how compounding works over time. And basically the longer your time horizon, the more potential returns you're going to have, of course. And it's usually in the later years of your compounding that you're going to see the biggest benefit. And so we've got an example on the slide over here, a 20-year period versus 40 years. And so, just doubling the time horizon doesn't mean that you're going to be doubling the amount of money that you're going to make over that period. It's actually over 8 times more that you could be making over that extra 20-year period, considering all other factors being the same. And so what I mean by compounding in the later years is that you're going to see so much more of a return in those later years. So getting invested as early as possible definitely benefits you the most.
Now, let's talk a little bit about, excessive hype. I was like, that's been around social media, the news, and everyone's been hearing about that quite often, especially during the past year or so with COVID and the markets being so volatile and unpredictable. How would you approach investing in a market after a market sell-off?
Yeah, so during the whole pandemic, there was a huge sell-off in the market. There was fear everywhere. I remember being at work and all everyone was talking about was the market sell-off and all of these circuit breakers going off in the market just because it's going down so much. And there was fear and panic everywhere. But personally, what I believe is so important to being an investor is staying level-headed and controlling your emotions when you're investing. And so I think, trying to take advantage of these opportunities in the market whenever the market is dropping is the best approach that you can take. And just keeping that long-term mindset, investing in the market over a period of 1 year is very insignificant over the period of your lifetime. Mm-hmm. And it doesn't really mean anything in terms of your portfolio value, but over time, it's definitely going to increase. Even though you go through a market crash, there's always better days in the market. So taking advantage is definitely the best approach.
Yeah, taking a breather, knowing that everyone is actually going through the same thing. Because at that time frame, even like stable companies could be at the later end of that at that percentage as well, right? And I think this really ties into what you mentioned about your investor profile again, and just really figuring out what your goals are and trying to stick by that. And of course, being level-headed. So I'm sure you've heard a lot about those excessive hype that's been going around a lot with investing and trading and speculating. If you could just give us an idea, how do we do investing and how does speculating kind of differ?
Yeah, so I think of investing as understanding the underlying fundamentals of a business and knowing the future growth prospects of that business. And by investing in that, that over time, the asset price is going to appreciate. Whereas speculating is sort of like gambling. You're just taking a recommendation from a friend. You're YOLOing your money away. It's hoping that the asset price is going to go up over time, but you really have no idea. So you're kind of just gambling.
Yeah. Yeah, I feel that. But for those of us who might still want to be in part of the hype and not miss out on that, is there any questions that we can possibly just take a breather and really ask to find out about those fundamentals, about those companies? Is there anything that you might look for just to give it a little bit more than just hopping into that type of security right away?
For sure. So just like with any investment, I'm going to ask a lot of questions about what this business is about or what this type of asset is about. So, for example, does it have good management? Does the price make sense? What are the underlying fundamentals of this business? Is it making money? Is it growing its revenue? Is it growing its earnings? These are tons of questions that Warren Buffett asks about his investments. Does this company have a moat? Is it solidified within its industry? Is it an industry leader? All of these are very important questions. And of course, does the price make sense is the last and most important question. And a lot of times with these hype stocks, the price is just through the roof and really is detached from the fundamentals. And so these are all of the types of questions that you want to be aware of as a millennial investor. And if you see all of these hype stocks being promoted on social media, it's definitely important to ask yourself these questions.
All right. So lots of things come in play when we are investing, right? And I know you mentioned previously about like a market sell-off and just being emotionally. So why do you think investors or millennials or at any age, why do you think we might act emotionally even though we might think it's a bad idea?
Yeah, so investors and people in general generally make their decisions based on emotions, and then they'll try and justify those decisions with logic and reasoning. And so, we are emotional beings, so we make these decisions based on emotions. And the thing is, too, that people are going to do a lot more to avoid pain than to gain pleasure if they're both in equal amounts. And so whenever you see a market sell-off, individuals might want to avoid losing the amount of money that they've already made and worked hard for it. And so they're going to see that as, oh, I need to preserve my capital, so I'm going to sell out right now. Whereas they don't keep that long-term mindset. That's very crucial as a long-term investor. And, sticking the course and actually buying at those lower prices to stick it out over the long term and actually see that greater price appreciation over long periods of time.
Yeah, and those are things that we would finally think about after the emotional roller coaster is kind of like cleared out. So you've had quite a bit of experience. So in the beginning, when you weren't didn't have that good of a grasp on your emotions, or maybe you were right off the bat really good. But was there any indications that might? No, not trial and error, right? Is there any indications that you might have picked up from yourself where you're like, well, Nick, you're emotionally investing right now because maybe I'm doing this, and any cues, body cues or thought cues that might have led to you realizing that this is emotional investing?
Yeah, for sure. So there are a few. First of all, I would say if you're feeling a sense of urgency or anxiety with regards to your portfolio, like meaning that you're needing to do something right at this moment, take a step back and think, do I really have to do anything? The market is crashing, but let's just take a step back and make decisions rationally, because what ends up happening is you'll make a decision very quickly and without actually thinking through it rationally. And so those senses of urgency and anxiety, also if you're feeling this sick feeling in your gut on a really bad day in the market, it's important to, again, take a step back and understand that this is only temporary pain. It's going to be okay. It's going to make it through the storm. And so those are probably the biggest things for me when it comes to emotional investing.
Okay, so those would be like little techniques that you kind of use to calm yourself down and just see if you're still clearly thinking about all those items before actioning them.
Yeah, well, some other techniques for me would be to not look at my portfolio value is one big thing. So, you can see so your stocks. Yeah, just not pressing that login button is probably the most important thing you can do. And there's something about seeing the amount of money that you've put in being in the red and, just having those paper losses, it really hurts and it takes a dent on your ego and almost makes you want to sell out to preserve your capital. So avoiding logging into your brokerage account on really bad days is probably one of the best approaches. And another approach that I like to take personally is to get away from the computer screen, get away from the office, get away from your house, go to the gym and get some exercise, because the release of endorphins when you're exercising actually reduces sensations of pain in your mind. And it almost acts like an analgesic, but in terms of your head and just clearing your mind. And so getting exercise definitely helps a lot with dealing with emotional issues, whether it be investing or other issues in life.
That's true. It's just usually getting out the door. That's the hardest, but really good points there.
Yeah.
All right. It seems like you have quite a lot of idea techniques and tricks for yourself, and of course your own experience with your investing as you've aged or got more experience. Has any of your habits changed that really allowed you to master your approach and your kind of like zenness right now?
Yeah. So in the beginning, I was very, I guess you could say I was a little bit scared to be in the market. And so I would be checking stock prices every 5 or 10 minutes and just seeing, oh, no, like I just lost $2 and crazy little things like that. And just being very, very concerned about stock price and like where my portfolio value was at. But then as I realized, stock prices are going to go down. They will go up over time. There's no way to avoid temporarily losing money as an investor. I'm sure every single investor has been in the red on one position at one point. It's inevitable. And so we just need to realize that it's a long-term game and you need to stay invested and not just focus on the day-to-day price fluctuations. And so over time, I've become a lot more tolerant and resilient to volatility in the market. And again, using those techniques that I've told you about, exercising, avoiding logging into my brokerage account when I know, say, a position isn't doing so well. These are all techniques that have helped with that.
Great. Well, I definitely have a few things I've learned from you today. So thank you so much for sharing all of your stories and your experience and your outlook. With everyone else here, is there any final takeaways that you can leave us millennials, if I'm still considered one, any of our millennial investors out there when we're first starting to invest?
Yeah, so I just want to leave it by saying investing is a long game. You have to stay invested for the course. A period of 1 or 2 years, if you're not seeing the types of returns that you expected, don't be discouraged. It's definitely a long game, and just continue buying, continue investing regularly every month. And eventually over time, you will see the returns that you were expecting, and you will do very well over the long term.
Really well put. That's something that I have to also keep remembering, that again, it's for my future. It's not something I need now. So long game, it's a game, like you mentioned earlier, it's not a sprint, it's a marathon. So we need to preserve all of our energy here. Awesome.
Yes.
I think this was a great conversation, and thank you so much for taking time to, again, come out and spend some time with us. I know you're in BC, so the time frame's a little bit different, but this was awesome. Now, I mentioned earlier that I was able to come across you on a lot of different channels because you are actually a social influencer, like an influencer to a lot of us millennials out there across the world. Could you please just give us a little bit more idea on, if we were interested in following you, getting to know you a tad bit more, where can we find you?
Yeah, for sure. So my main page would be YouTube. You can find me at Nick Peitsch Investing on YouTube. You could also just say Nick Investing, probably, and it would come up. And so that would definitely be my main page. I'm also on Instagram, and Nick Peitsch Investing as well. But definitely check out my YouTube channel if you're interested in stock market investing. And I make all sorts of videos trying to educate newer investors and definitely show my progress as I'm going along the way on my own journey.
That's it for our webinar today. Thank you so much for tuning in. Hope you all enjoyed that. And please stay tuned, as we are actually going to have a live question and answer with Nick. So I hope you all send a lot of questions, because there's only going to be a few that's going to be answered. But let's hop right in so we can have a little bit more conversation.